GZERO's coverage continues now from the World Bank IMF spring meetings. Margaret Franklin is the CEO of CFA Institute. It's good to see you.
Great to be here.
So one thing that's been striking me in conversations I'm having this week is that people are pointing out the economy and economics and geopolitics are intertwining in new and more frequent ways. Do you find that?
We do, and actually it's become a feature of our CFA program. It's embedded right into the curriculum and was identified by industry leaders that geopolitics was becoming a much more important factor it's always been there, but a much more important factor for investment decision making. What's interesting at this particular moment in time is there's so much going on in geopolitics, and yet it really hasn't had the kind of impact in markets that we expect. So that creates an interesting tension that we expect will play out over the coming months and years.
When you say it hasn't had the impact on markets, you mean in the longer term? Because it seems to me like there have been blips here and there. Certainly 2020 was a big downturn during COVID, for example.
I think if you look right now, all three major theaters have wars going on. They're consequential. We have, tensions around the world, an increasingly fragmented world. And yet most of the investment world is really focused on inflation, the regulatory regime, when you think about things like crypto. And so we have days where, outside of COVID, which was a global phenomenon, we have days where escalations that would normally be very disruptive to the markets and last longer are really just blips. As you say, they're blips in the market. And so everything right now seems to be hinging on inflation and interest rates and then sort of regulatory environment.
We talk about the converging crises the world is facing as though it's 2020 to 2024, but you were pointing out, actually we've been through more than a decade of some pretty major global incidents. Do you want to explain that?
Yeah, so if we go back to the great financial crisis, while it impacted countries to varying degrees, it impacted everybody. And we saw really a shift from the consumer household balance sheet and business balance sheet to the sovereign balance sheet. You know, if you think back to what the economists were predicting, that sovereign debt would overwhelm the system and we'd have these great catalytic crises. And really outside of Portugal, Italy, Greece, and Spain, we really didn't see what we expected there. Then, of course, we had COVID, we've had AI, and now we have these incredible geopolitical tensions. And so I think there's almost a level of immunity to the dramatic nature of it until something really cataclysmic happens. And the response, generally speaking, has been pretty positive, right? You know, we've had tremendous central bank intervention to save the markets through the great financial crisis. But, you know, for most of us in the business, and for those of us who've been here for decades, we've had a period of declining interest rates, declining inflation, and growing GDP as a result of the fall of the Berlin Wall. We unleashed incredible Eastern European talent and cheap Asian labor that made the cost of goods go down. Now we're at the bottom of that. We've seen inflation rising, we've seen higher interest rates, and a more fragmented market actually is the exact opposite of that. So we don't have a playbook exactly to lift and shift to this environment, and so it's going to be interesting to see over a much longer period, 5, 10, 15 years, how this all plays out.
So you mentioned a bit about changes that you've experienced here at the bank.
Yeah.
I hear World Bank leadership talking about a bigger and better bank, a roadmap to changing the way they do financing. Explain what that means for all of our viewers, but also what that means to you as a private sector investor.
Ajay is from the corporate world. He's from the private sector, and I think that shows up. I mean, of course, he was just new in seat this time last year, but you can see already, again, an interdependency and interconnectedness, an understanding of what will release or crowdsource private capital to public sector aims and objectives. And so a really good example is that they've evaluated what kind of risk profile will private sector accept. And so they've structured it such that the World Bank will provide that first layer of protection, And then you can start to crowdsource in private sector money. It can be from pension plans, it can be from endowments and foundations. The instruments will be structured in a way that's attractive. And we just spoke with the World Bank, and their ability to connect specific country projects in investment vehicles that are attractive to crowdsource that capital becomes very powerful. And that's the whole idea behind the World Bank, is to create leverage. Not that they provide everything, but they create leverage. The second thing is, you won't be surprised, from a private sector leader, they are going to think about what are the key performance indicators, what's the governance around it, how do we measure and make sure that what we intended we're getting. And we can see evidence of that. Last week they released the emerging market debt data. How have their loans performed over the long history of it? And investment professionals need that information to understand what worked and what didn't, and what the features that they're proposing now have a better profile or enhance the features to make it more attractive. So between the data, the structuring, and the sensibility of understanding how you attract that capital, those three things with a sense of urgency and some discipline, I think really make it quite exciting.
Let's end on some news people can use. So This has been a relatively chaotic few years. Where are the opportunities for investors right now?
So I think it remains a chaotic environment. The first thing I would say for investors is to really evaluate your risk profile. That can apply to individuals as well as institutions, right? So we hear a lot about what sovereign wealth funds are doing, what the leading, the most notable investors are doing, and oftentimes that can't necessarily translate down to smaller institutions or individuals. So the first thing is to evaluate what is your risk profile, and make sure that you kind of get that lined up. I think, ironically, some of the fixed income offerings become more attractive. And I mean, there was a whole decade where fixed income wasn't attractive. It's become more attractive. And then, of course, making sure you diversify your portfolios. And at the end of the day, diversification is the basic tenet of good portfolio management for risk and return. Finally, for younger viewers, be very careful about the sources of your information. We've just published a Finfluencer piece, and we know that the incoming generation, these early generation of investors, are very susceptible to social media. They're often not licensed, they're often not regulated, they don't disclose what their conflicts are, so it's very much caveat emptor.
These are people, you mean, like just on TikTok or Instagram, who are offering
YouTube,
financial advice?
Should
that be regulated?
Yes. Because at the end of the day, what you're really asking is the investor to be much more sophisticated than they need to be. And that does, I think, fall into the regulatory environment. And it could be just as simple as making sure that the disclosures are there. I'm paid by this sponsor, they provide these services, you need to disclose it. That's a basic tenet of conflicts.
That is a very useful point to end on. Margaret Franklin, thanks so much.
Thanks so much, Tony. Great to be here.
Great.